Hey there, Brian Bogner and Greg Towner here, and we want to take the next few minutes and talk to you about the bear market that no one is talking about. First, let's start with what everyone is talking about. Yes, last week we had a very volatile week in stocks. It was worst week since 2008. That's what our conversations have been around. That's what a lot of folks have been talking about. But there's something else that's going on that affects all of us, okay? And it is the bear market in interest rates, okay? And this chart here only goes back to 2010, but the 10-year Treasury, which just about everything that you borrow on, whether it's your mortgage or car or whatever, at some point you can get back to the rate of the 10-year Treasury note, kind of sets what those rates are for all those things. And what we had happen last week is that broke to, I would say, what, Greg, multi-decades, century low? I don't know if I can go that far back.
I think it's an all-time low, actually, yeah.
Yeah, okay, so we had that happen last week. And we didn't have, I don't know about you, Greg, I didn't have one conversation with a client or anyone about it. Everyone wanted to talk about the stock market.
Right.
So we thought it was real important to talk to you about this and how it affects a couple things here, Greg. So take it away.
Yeah, absolutely. That's great. And let's start off with how it affects the stock market. So, one of the ways that you evaluate valuation for stocks is how do they compare to other alternatives, such as yields on bonds. And this chart here shows us as this line is increasing, the amount that you receive in dividend yields from stocks is increasing compared to yields. So we see now you can get a yield on stocks about twice the amount that you get on the 10-year note. And that yield is going to be, or the dividends you receive are going to be increasing over time. We're actually back to almost the point that the spread on that of back to the 08-09 financial crisis. So you get roughly twice the dividend yield from stocks as bonds, and in high quality even more than that. So that's quite appealing from a longer term perspective. Obviously you got to deal with volatility, but for money with a longer term perspective, that's pretty appealing. And you said there's a couple different ways to look at rates. For those wanting to borrow or needing to borrow money, this potentially is a great time. We're at essentially all-time lows in 30-year mortgages, 15-year mortgages. They're back to those levels that we saw in 2016. I think a lot of places are actually lower than that rate. This is just a national average. Some places are lower. So if you're borrowing money, and again, that bear market in bond rates is a good thing for people that are looking to borrow money.
So again, short video in summary, stocks are actually attractively valued compared to bonds right now, historically, with this drop in the 10-year and even this drop that we've had in stocks as well. So historically, that's been a good time to participate in stocks compared to bonds. Secondly, with these low interest rates, it's a great opportunity also to lower your borrowing costs. Okay, so if you haven't refinanced in a while, or maybe there's something you're looking at potentially purchasing, or you're not sure, should I pay cash for it or should I borrow the money for it? Let's give us a call. These are the conversations I think right now we would much rather be having. Is let's talk about your loan situation or your borrowing situation or what you're wanting to do. We can run comparisons. We can show you differences and things like that, and show you different scenarios and what makes sense and doesn't there. So as always, you know where to reach us. 864-385-799 is our number. You can shoot us an email. Here's Greg's emails here as well if you want to shoot him an email, and we'd be happy to talk to you. Thank you so much for listening.